Remove 40 to 80% of your retirement income off of your 1040 tax return. In this video educational episode, I'm going to address how much of your income at retirement should be tax-free. A lot of people don't think about this. Get ready, put on your seatbelt. I'm going to blow you away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 48 years, helping thousands of people optimize their assets and minimize taxes and prepare for a comfortable retirement where they hopefully will not outlive their money. Now, one of the secrets to not outliving your money during your golden years is to convert anywhere from 40 to maybe 80% or more. Some people have 100% of their income at retirement totally tax-free. I'm not advocating that in this video episode, but get ready. If you've watched very many of my educational episodes on this channel, Three-Dimensional Wealth, I'm very passionate about helping people understand how to accumulate money tax-free, not just tax-deferred, and then be able to access that money tax-free, even before retirement if you need it, but especially during retirement to be able to have tax-free income. The IRS will know you're receiving this income. They know everything. But they know that it's not subject to tax. It hasn't been. It's been protected for more than a century in the Internal Revenue Code. And so my favorite vehicle to accomplish this is a max-funded indexed universal life insurance contract that's structured correctly and funded properly. And this is where I have actually earned average returns of 9.62% for more than 42 years. I can show you how to do this. There's a lot of naysayers that do not believe that, and I show them historical averages where I've earned 11%, 16, 25, 61% on my indexed universal life. It must be structured correctly and funded properly to pass what I call the liquidity test, safety test, rate of return test, and then tax benefits are icing on the cake. And so that's why we call it the laser fund. A laser fund is a properly structured, max-funded indexed universal life because laser is an acronym that I have used for years that stands for Liquid Asset Safely Earning Returns. So I want to start out here with a story of a couple that came to me. They lived in the San Francisco Bay Area. The cost of living there is much higher, and many of them have accumulated $2, $3, $4, $5 million in their IRAs and 401ks and the like. And so this couple, they came and they were proud of themselves, and I congratulated them. And they had accumulated about $2.7 million in yet to be taxed IRAs and 401ks. And I looked at it and they could tell that I was concerned, and they said, well, what's wrong? We feel like we could take about 6% a year out of this account, which calculated to be about $160,000 a year. And then they also had about $40,000 a year of Social Security income and a little bit coming in from when they had taught school for about 10 years earlier in their lives. And so they had about $200,000 of income with all of these resources, but $160,000 of it at 6% payout from that 2.7 million was all yet to be taxed. So I said, well, yeah, the problem that I see as a tax minimization specialist is that 100% of this is all showing up on the front page of your 1040 tax return. And they reacted as normal, like, well, you mean there's another way? And I go, yes. And so I taught them about a strategic rollout. This is not a rollover. This is where we strategically get the money out of those IRAs and 401ks, maybe 40, 60% of it, 80% or 100%. Some people say, I don't want to have any taxable income in retirement. And I say, well, we're going to have to pay the tax now, which they agree. Getting the taxes over and done with sooner than later, if you believe that taxes in the future will likely be higher, is actually very smart. Most people, they get duped, I think, into postponing, deferring, procrastinating, paying tax until they're age 72. And then they're told to take RMDs, required minimum distributions, thinking they're saving tax. No. When you string it out during your life expectancy and your spouse's life expectancy, and then you leave behind the rest to your children, and they have to pay tax within 10 years after inheriting that, I can prove to you mathematically that is not smart. And most savvy CPAs and tax attorneys who have done the math will agree. So what we did with this couple is we did a strategic rollout. So this required that we do a rollout of about $600,000 a year. So out of the $2.7 million, we did $600,000 a year because they were earning interest as we were doing it. So we ended up with about $3 million that came out. $600,000 a year times 5 years is $3 million. Out of $600,000, even in a 33% tax bracket, they only netted $400,000 after paying tax. Yeah, it was painful, but they're going to pay the tax sooner or later, and they realized they would likely be in a higher bracket or taxes would go up because of irresponsible government spending and the printing of money and so forth. And so we netted $400,000 after tax out of every year's $600,000. And so we had $400,000 times 5 years. We ended up with $2 million. Where did we put it? They don't have to spend it. We repositioned that in the strategic rollout to a portfolio of max-funded indexed universal life insurance policies. And so we ended up with $2 million in those IUL policies, what I call laser funds. Now, those laser funds now are producing a rate of return averaging between 8 to 10%. But because of the strategies that we teach in my various books, and I want to gift you a copy of our most recent best-selling book at the end of this video for free. And so stay with me. But that $2 million, they are actually letting it grow a little bit. But at $2 million, I showed them they can now generate the $160,000 a year based upon an 8% payout. So 8% on $2 million coming out is $160,000 a year, which is what they were going to get at a 6% payout because they were only averaging actually less than 6%, but they thought they could maybe average 6% by leaving it in their mutual fund portfolio. But Wall Street made them nervous, with the ups and downs. So they wanted stability. A max-funded IUL policy will help you benefit when the market goes up, but you will not lose one dime due to market volatility if the market goes down. And you need to learn why. That's called indexing, and I'm not talking about index mutual funds. The end of the story is this. We were able to now generate $160,000 a year of tax-free income. They still had their $40,000 of Social Security and a little bit of school teacher pension, but hello, we were able to get 80% of that $200,000 of income off of their 1040 tax return. Yeah, the IRS knows they're receiving that $160,000, but it's been tax-free in the Internal Revenue Code now for over 108 years. And people say, where in the Internal Revenue Code? Well, in sections 72E, 7702, and 101A. Watch other educational episodes on this channel. You'll realize that money inside of an insurance contract accumulates tax-free under Section 72E. Under Section 7702, you can access that money totally income tax-free if you do it the smart way, and that's what they're doing. And if they live to be 120, they'll be able to enjoy $160,000 a year of tax-free income. They can increase it from that if they want also, and they don't have to pull that out. There's no required minimum distribution. But at the end of the day, anything that's left in there when they pass away will blossom and transfer income tax-free. That's under Section 101A of the Internal Revenue Code. Nothing else does that I'm aware of in the Internal Revenue Code. So that's the rest of the story. They are so grateful. Sometimes when I meet with people at retirement, at least 5 years before retiring, and they see the wisdom in doing a strategic rollout, they are so grateful, and we're able to get 40%, 60%. In this story, 80% of their income, 80% of that $200,000 a year of income we got off of their 1040 tax return. Sure, the IRS knows they're receiving it. It's not even worth auditing because it's been tax-free for over a century. So if you want to learn more about how to convert as much as 40, 50, 60, maybe 80%, we did have one couple in California. We took them from the highest tax bracket to a 0% tax bracket in 5 years. And they're now enjoying $800,000 a year of tax-free income. Technically, they don't even have to file a tax return because they said, no, we're sick of paying taxes. And so they got through paying all the tax, and now they're enjoying $800,000 a year of tax-free income, totally 100%, a 0% tax bracket. So if you want to learn more, I mentioned I want to gift you a copy of our most recent 300-page best-selling book called The Laser Fund. Now, this is actually 2 books in one. This white-covered side is about 200 pages, comprised of 14 chapters with all the charts and graphs and explanations of how to diversify and create the foundation for a tax-free retirement. If you learn more by stories and examples, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. And so it's good for the left brain learner and the right brain learner. If you want to use your whole brain, I would read both of these books. But you don't have to pay $20 on Amazon for it. If you do, thank you. But I want to gift you a copy. Here's how you claim your free copy. You simply go to laserfund, L-A-S-E-R fund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. And I will pay for the book. I will fire out a hard copy to you. There's also options when you're in that website to listen and learn if you'd rather, or watch and learn. There's a masterclass in there. There's also notices of different educational webinars that we do. And you can even schedule to talk to an IUL specialist to see how any of these circumstances or these strategies can apply in your particular set of circumstances so that you can convert as much of your retirement income to totally be off of your 1040 tax return. So here's to your brighter future.